Today, we're going to be diving into a topic that might sound a bit confusing at first: overfunding a whole life insurance policy. In your research, if you ever wondered what does that actually even mean, don't worry, we're going to break it down step by step. So first, overfunded aside, let's talk about what a whole life insurance policy is. Okay, a whole life insurance policy, simply put, it's a type of life insurance coverage that provides coverage for your entire life. And it has three main components to it that we'll be talking about, which are the base, paid up additions, and term riders. All right. So the base component is what purchases the death benefit. If there is no death benefit, it's not life insurance, right? So a policy that's 100% base is optimized for death benefit, meaning that there's no cash value, or at least there's a really small amount, and it just takes a while to really catch up to speed there. For example, if you have a policy that's 100% base, your cash value in those first couple of years is going to be $0 in most cases. Whatever your premium is, that's what you have to owe every single year. There's literally no flexibility. If you can't make your payments, your policy ultimately gets canceled, especially early on in those policy years. Next, we have paid up additions, or PUAs. And this component goes straight to cash, although it does purchase tiny bits of death benefit as well. In an overfunded whole life policy, we typically lower the base and increase PUA. So for example, you could have a 40% base with 60% PUAs, or it could be 20% base, 80% PUAs, 30, 70, 50, 50. Like the list kind of goes on, but the more you contribute to PUAs, generally speaking, the higher your cash value will grow. So just know that there's some limitations to how this can be structured, and I would highly encourage you to work with someone who kind of really knows what they're doing, not just in any life insurance agent, but someone who specializes in designing overfunded whole life insurance policies specifically. Okay. Now, anyways, over time, I want to talk about overfunding a little bit. So over time, for every dollar that you put into a policy, the more you're going to get back. So at first, you might get 70 cents back, and then 80 cents back, and then 90 cents, and so on, until eventually you get to a point where you're getting more than $1 back for every dollar that you're putting into it. So it definitely is more of a longer term play, but it's not necessarily have to be that long per se. You'll see what I'm talking about in a couple of minutes here. Now, I want to highlight something about these policies, right? Knowing that, it takes a little bit of time to get it going. It's similar to a long flight. I once flew from Dallas, Texas to Sydney, Australia. Super long, 17, 18-hour flight. And the plane became more fuel efficient as it burned off more fuel because it became lighter and lighter. In a similar way, the longer you keep your policy, the more efficient your policy becomes. And lastly, we have the term rider. This is adding an extra death benefit at a very low cost to justify the amount of contributions we're making relative to the base and PUAs. It's essentially a required cost to meet IRS rules in order to maintain tax favorable status of your cash value. And the rule that I'm referring to here is the MEC, or a modified endowment contract. It's an acronym. So this would result in your cash value being taxed more like a 401k or an IRA, because the policy would no longer fit the definition of life insurance. And so in some cases, this is going to be needed to be added. And I would even say in a lot of cases with folks who really want to enhance the amount of cash value that they have. So you have these various components, right? You got the base, focusing on death benefit; PUA, focusing on cash value; flexibility for the PUAs is high, flexibility for the base is very low. And that term rider keeps you in IRS compliance, basically. And so to kind of visualize all of this, you can just put it together in a big container, or some sort of a container. Your premiums that go into the container all are split into base, PUAs, and term rider. The ratio between these components determines your cash value and whether it's overfunded. So if you, for example, have a policy and no cash value in it for the first few years, your policy likely isn't overfunded. So for example, you put $30K a year into a policy. By the end of that first year or two, if you have nothing to show for it in cash value, your policy is likely not overfunded. And on the flip side, if you put $30K into a policy in that first year and you have 20, 25K of available cash to use, your policy is overfunded, right? That's kind of a decent way to think about a test for what you have. And so I want to illustrate this difference by looking at two actual policies that I've designed. One of them will be a traditional policy that has a main focus on death benefit, especially early on. And the other is an overfunded policy that maximizes the paid up additions component, resulting in accumulation of cash value a lot faster. So let's take a look at this, right? We have $30K per year going into this policy for 20 years, okay? In this case, the death benefit is over $2.8 million. That's how much is being purchased. And this is the reason why the cash value is literally $0 for those first couple of years. Even 10 years down the line, you put in $300,000 and you have a decent level of cash value. That's not nothing, but it's not even dollar for dollar access, and you've gone 10 years with this, right? On the flip side, you have an overfunded policy. Same amount of contributions, except the difference here is that 30K just so happens to be your ceiling. The floor in this particular case with this design, you can't see it on the screen, but it's about $5,500. This results in that 22K of cash value that you're seeing on the screen, with you having dollar for dollar access by that 7th year. Now, something else that's worth noting is this question here. So for every dollar that's contributed in premium, when do I start getting more than $1 back? That is starting to happen in year 4. In that case, 30 grand was put in, you're getting back almost 32 grand. And so the longer you keep your policy, the better the growth you'll see within the policy relative to the dollars that you put in. Now, the reason this is so powerful is because this is safe money. This is a safe place to store capital. There's a guaranteed component to these policies, which I won't get into today, but there's a guaranteed component. There's also a dividend, which although isn't guaranteed, it's very strongly assumed when you're working with a company that's been around for a very, very long time, right? They're a mutually owned carrier, and they've been paying dividends for 150 plus years without missing a single year. So what does overfunding mean? It's nothing more than contributing above and beyond your minimum premium up to certain limits set by the IRS. And again, that minimum premium makes up of the base and term rider cost in order to satisfy the death benefit need. This allows your cash value to grow faster, giving you way more financial flexibility, meaning that you can contribute more or less and that there's not this rigid contribution schedule you have to stick to. If you want to dive deeper or if you have questions, feel free to leave a comment or schedule a one-on-one call with me. This is what I do for a living and I'm happy to help. If you enjoyed this video and you learned something, go ahead and hit the like button and subscribe if you want to see more videos about life insurance. Thanks for watching. I'll see you next time.